would be the 10,000 that I put for the right to buy that house for $100,000. So the premium is what you're paying for the actual contract itself. So a lot of times, especially if you're on like Robinhood or something like that, a lot of times people will see, yo, hold on, give me 1 second. It's hot as fuck. I'll put the AC on. The fuck? How the fuck it got so hot? Yo, my bad. I was fucking steaming, son. I was hot as fuck in this room. So it's like 80 degrees right now. I'll put the AC on real quick. Yo. So boom, when you're on Robinhood and shit, like a lot of times you'll see, like when people pull up options contract, you'll see another thing that says the break even price. So what the break even price is the actual strike price plus the premium you pay per contract. So even when you see a premium, it'll be like, the premium will say, 21, you'll see an option contract and it'll say like 21 cents and then you buy one, but it'll be like $21. It's because it's 21 cents per share. So when you buy the contract for 100 stocks, the price is $21. So if you look at the break even price, so say if your the price you paid for the contract was 50 cents and the strike price for that same Apple example that we had just now was $6, the break even price that you'll see like on your Robinhood or whatever the hell you use. A lot of other trading stocks don't really show the break even price. It's like a Robinhood thing. But that break even price that you see on Robinhood would be $6.50. So it'll be the strike price plus the premium, and that'll be what the break even price is. And that's essentially when your contract becomes profitable if it's a call situation. So you would need Apple to be $6.50 for your contract to actually break even, because it's the $6 that you agreed to plus the 50 cents for it. So, and then last but not least, they're always going to have an expiration date. So this is the key factor in all options contracts. They always have an expiration. That's really what they are. That's what makes their thing. And this is what kind of makes the market, because the fact that they expire is what gives the other end and what gives sellers incentive to even want to sell the contract and generate it. The fact that it can expire and they can make money off of the actual expiration of the contract itself. So again, the option contract, I want to reiterate, is the right to buy or sell 100 shares of a stock at a predetermined price and a predetermined date. The predetermined price and the predetermined date is of your choice, and whatever you choose will affect whatever the price you get that contract for. So, just as a general rule of thumb, contracts that are farther out in date will cost more money because they have more time to mature. The adverse part of time, the time decay is affecting it less. So those contracts will, that's a general rule of thumb. And in terms of the strike price, the general rule of thumb is the closer you are to the actual the more in the money, and I'll explain these concepts, but just for now, we'll go into in the money later. I don't even want to go into that right now, but the closer you are to the stock price, the more expensive the contract will be. The further away you are from it, the cheaper it'll be, because again, it's just going to have cost is going to have a cost risk is going to have a inverse relationship. So contracts that are more likely to be profitable are going to be more expensive, and contracts that are less likely to be profitable are going to be cheaper. But also on the flip end, when a person does take a riskier contract and say that person does get the price movement in the direction that they wanted it to go, those contracts will increase in value at a much more volatile rate than the more expensive contracts, but they will also lose value at a much more volatile rate than those more expensive contracts. So the more expensive contracts you'll see are going to be safer, and that's within a option chain of a stock. Like, don't compare option prices for different stocks. Like, every stock is going to be different, but I'm just speaking to the various option prices within an option chain of one stock. So, the main difference, like, kind of really between, stock trading and option trading is like stock trading is really you really have two directions. You can either buy or sell a stock. Like, that's it. There's only two directions. Options, through a combination of different strategies, you can make money on a bunch of different types of price direction. The price direction doesn't necessarily have to go up. It doesn't necessarily have to go down. You could make money off a sideways price direction. So there's different spreads and strategies that you can do that make kind of options much more versatile. But the real main difference is and because I'm not really going to go into spreads, that's a little more advanced options trading, but the main difference between stocks and options trading is the actual leverage. It's the fact that you can put up a small amount of money and have it leveraged across 100 shares of stock. So when that price movement does happen, instead of, if that money could have probably bought you 1 or 2 shares of the stock and it would have went up 5%, if you had it, an option contract that's leveraged on over 100 shares of stock, that same money invested would increase way more than 5% just because of that 100 leverage. So again, it's a gift and a curse. This is why options are very risky. This is why usually, even when you have like a stock trading app and you want to start doing options, they'll usually like give you some type of questionnaire or make you call, or they'll usually want to ask you some extra questions, purely because of the volatility, because it's very easy to lose money. And your money could go quick. So again, that 5% drop could mean an 80% drop in the option price. And a lot of people can't really stomach that on a day-to-day basis, which is why a lot of people, one, aren't even successful in it. It's not something that everyone is good at. A lot of people aren't. And two, it's kind of why a lot of people don't necessarily need to be trading it, honestly, because you got to kind of have a certain type of profile to even be able to kind of deal with the swings that happens in this type of trading. These type of swings won't happen in stocks because you won't see a stock, for the most part, go up or down 30% in a day. A 30% swing in an option contract is nothing. That shit can happen in 5 minutes. So it's like, these are the differences, and these are the things you got to kind of take into consideration when you even do think, do I even want to get into this? So you asked, somebody asked, so you're really purchasing potential. Yeah, theoretically, yeah. I mean, when you're buying an option contract, I guess you could look at it like that. But again, I don't want to necessarily say it potential, because that makes the assumption that like we're always banking on a stock to go up. You can be betting on a price direction the other way, and you'll buy put contracts, so you'll buy options that are the right to sell, as opposed to call contracts, which are options that give you the right to buy a stock. And I'll go explain those out later. But you can bet on the price direction either way. So yeah, it kind of is. I guess you're buying potential, because yeah, you're banking on price direction. So you're betting on the direction of a stock, whether it's up or down. So I guess in some regards, you kind of could look at it like that. So hold on, let me see my notes. I kind of wrote like a little timeline so I could kind of stay on point. So one thing I also want to note out in regards to leverage, this leverage and this is purely on the buyer side of the option, and this is why, and this is what we're mostly focusing on. The seller side of the option, when you generate the actual contract, there are unlimited potential for losses, but on the buyer side, which is what we do and what we're focusing on, all of your risk is limited to whatever capital you put in. So if you put $100 on contracts, the most you can lose is $100. That's it. On the flip side, in terms of upside, because these are options, theoretically upside is unlimited. It's not capped. So if a stock keeps going up, the option price will keep going up. And, a stock can't keep going up forever. So obviously once the stock stops, the option will stop. But this is why theoretically option upside on contracts is unlimited. So that's kind of another difference when you want to kind of talk about stocks and options. When you do buy a stock and prices go down or prices go up, you still own that stock and you don't actually realize a loss until you actually sell that stock for lower than you bought it for. So if you have a stock and it's been going down for the last 3 years, but you held for 10 years, and in the next 5 after that, it went up double what you made, you never realized the loss. And that's the difference another difference with option contracts. Because you have this time element on it, you do have to get your price direction to happen within whatever time you allotted yourself for the contract in order for you to actually return a profit on that contract. Now, again, to make money on an options contract, so I want to go back to use that same Apple example. So we had the contract, the Apple was $5. We bought a contract for it that expires next year, and it gives us the right to buy Apple at $6. Apple goes up to $5.75. It's not $6 yet. Whatever we paid for that options contract, that contract itself is now worth more than how much we had it for. All other things being equal. And assuming we still have a lot of time on the contract. Because if, as we get close to the expiration date, if the contract expires the next day, that raise in price doesn't matter. This is assuming the contract has tons of time on the back end. So if Apple goes up to $5.75, your break even, which is $6.50, wasn't met. Your strike price wasn't even met because Apple isn't at $6. But at that moment in time when Apple is $5.75 and you bought that contract when Apple was at $5, your contract is worth more money. How much more it'll be worth will always vary. I can't tell you the exact amount it'll be up, but it'll be worth more than what it was at that point in time. At that point, you could sell it and take your profits right there and keep it moving. And that's essentially kind of what we do with options in Options Gang is we just kind of flip these contracts. We'll take a contract, hold it, ride it. We have target price, target dates that we're focused on. We ride that contract up. Everyone has different targets and goals in terms of how much profit they want to get out of a trade. But, once people hit their targets, they sell a contract and then they out of the joint. We never really actually touch any of the actual stocks. We're just actually trading and flipping the actual options contracts themselves without actually touching the stocks. So, back to what I said, we're on the buyer side of the options. So like for people who have like Robinhood, when you go into options, you'll see on like that top tab, it'll say like buy or sell. This is on the buy side of the options. You don't really want to fuck with the sell side unless you really know what you're doing because, again, when you're on that sell side of the options, your losses aren't capped. So you can body yourself and give yourself a lot more losses than you one would anticipate. So when on the buyer side of the options, essentially there are two types of options. And all of those strategies that I was talking to you about, that like those advanced strategies, which I'm not going to necessarily get into, they're all based on variations of these two types. There's really only two types of option contracts that you could buy. You're either buying calls or you're buying puts. So when you buy a call option, you're buying the right to buy 100 shares of a stock on a predetermined date for a predetermined price. That's a call option. when you buy a put option, you are now buying the right to sell 100 shares of a stock at a predetermined price on a predetermined date. Now, when you have the call options or the put options,